Here's a concrete, illustrative example of the kind of transaction Jeffrey Epstein was known for, not a verbatim contract, but a faithful reconstruction based on court filings, reporting, and how these deals are actually structured. Example: hidden equity exposure via a total return swap. Goal: gain economic exposure to a public company without appearing as a shareholder, and without triggering disclosure rules. Players: Jeffrey Epstein, a large investment bank, acting as the counterparty, and a public company, for example a tech or financial firm. Step by step. Step 1: a swap agreement instead of stock ownership. Epstein does not buy shares. Instead, he enters a total return swap, or TRS, with a bank. The bank buys and holds the stock on its own balance sheet. Epstein agrees to pay the bank a financing rate, for example, LIBOR or SOFR, plus a spread, and in return, he receives all the economic performance of the stock, price appreciation, and dividends. Economically, he wins or loses exactly as if he owned the shares. Legally, he owns nothing. Step 2: no public disclosure. Because he doesn't own shares, he doesn't vote, and he doesn't cross ownership thresholds, he can avoid public disclosures, such as SEC 13D or 13G filings, and reduce public association with the company, along with scrutiny from other investors. This is regulatory arbitrage. It wasn't necessarily illegal at the time, but it was highly aggressive. Step 3: embedded leverage. Banks often allowed low initial margin, for example, 10 to 20%, with daily mark-to-market. So $20 million of collateral might control $100 million, or more, in stock exposure. Losses mean margin calls. Gains mean amplified returns. Step 4: the relationship kicker. Epstein often layered this with personal relationships. For example, he might privately advise or fund an executive, founder, or large shareholder. That relationship could influence the timing of trades, corporate actions, or access to private deals. This is where finance and social engineering merged. Why this mattered? This structure could hide true net worth, hide concentration risk, let banks claim they were the owners, and allow Epstein to operate in the shadows. After the Archegos collapse in 2021, regulators heavily scrutinized these same instruments, and Epstein was using them decades earlier. Dr. Epstein's typical transaction looked like this: I don't want my name anywhere. You hold the asset. I'll take the risk and the reward. We settle privately.